Welcome back to Happy Half Hour. That's Toby Weber. I'm Nik Schuurmans, covering all things market related. Certainly no shortage of topics to discuss. I've got 4 or 5 actually that I'd like to bring up with you.
Okay. I've got a few as well. I'll throw you a softball to start, unless you have a place you want to start. Okay. Based on your lack of answer. So we haven't done this for a while. A lot has happened in the last month or so. Maybe give an update on where things stand, market related, and what you're seeing from your perspective as we kind of head towards the end of the first quarter, 2026.
Well, I'll get into, like, if I do that, I'm gonna check all my topics boxes. But there's one thing that really sticks out, and it's a topic that we've talked about in the past, where the headlines are very aggressive. They're nonstop. They make people feel bad. Obviously, a war broke out, which you can't minimize the toll on human life and what that means for folks. However, when you look at the underlying market action, the S&P 500 is traded in a very tight range. But under the hood, it's been quite violent. There's like something to the effect of only 100 companies within the 500 companies in the S&P 500 are up or down 5%. The rest are up or down over 20%. So it's almost a barbell where most of the index is trading very volatile. The middle of the pack or a small subset is trading in a very tight range. And when you zoom out and look at the index, I think that the max drawdown this year is 2.5 or 3%. And today's March 18th. So it's not as bad as people would think. However, if you're a stock picker, you could easily find yourself offsides and getting crushed, which makes some people uncomfortable.
So what should investors take from that? What's the takeaway?
I think the markets are giving investors a gift, because we have all this stuff going on: inflation, what the Fed does next, a war, the AI disruption. We're still not that far away from all-time highs. But everybody I talk to, when we talk to prospective client portfolios, are still obsessing about performance. They have no clue about risk management. They're over allocated to the most popular and in vogue trades. The market is giving you a gift to go back to the drawing board and say, okay, how much risk am I taking? Does it reflect the way I feel about risk? Is it consistent with my financial plan? Most people are blowing past that yellow light and just continuing to think the same names, same themes are going to do well the next phase of the cycle. The most dangerous thing that you could do as an investor is think the current environment will not change and have no clue how much risk that you're taking until it's too late. So this is a gift. I would encourage those folks that have blinders on or are obsessing about performance, watching their account every day, go back to the drawing board and really be honest with yourself.
Yeah, I thought it was interesting. The returns for the asset classes that we use, that we follow, are really clustered around 0, plus or minus 2-3%. Everything is within that band. So despite the headlines, despite all the issues going on in the Middle East, despite everything that's going on today, the market has been very resilient, at least at the index level, to your point. I think emerging markets are up a little more than that. And gold still continues to be elevated. Although it started to back off a little bit from earlier in the year. So despite all the noise, if you will, we're almost 3 months in and returns have been fairly muted.
Yeah, then the other thing I'll say, I've written a few blogs about geopolitical conflict and future returns and the 3-headed monster, U.S. Treasury yields, oil, and the dollar. I think those 3 things are really important to watch, especially when a conflict breaks out. However, there's this habit amongst investors. When something happens, then they'll reach out or think, okay, now what changes can we make? These geopolitical events are basically untradeable unless you're a day trader and you're trading a very specific asset class or theme. But for long-term investors, it's easy to get caught leaning the wrong way. So, like, I always cringe when people think that headlines come and we make a bunch of changes. It's like, no. The work starts by building a diversified, risk-aware portfolio, understanding how every asset class you own moves in relation to each other. That's how a professional investor works, not making a bunch of knee-jerk reactions after something happens. Folks have asked me about sector rotation, buying asset classes like oil that perform well during an environment like this. I can tell you markets are forward looking and they're sniffing out the next thing. And these popular trades can unwind rather quickly and most investors get crushed. So I would pause for those folks that are looking to tweak their long-term portfolio. Unless you're taking way more risks than you set out to, now it's a good time. Again, the market's giving you a gift. I would go back and look at risk management.
So based on that, it's hard to escape the headline news, the headlines in the newspaper, what's going on in the Middle East. You go fill up the gas tank, and I think I filled up the gas tank yesterday, and gas was over $5 a gallon. So what advice would you have for folks just to kind of try to block out that noise? To, obviously there's a lot of angst, a lot of concern, a lot of uncomfortableness going on right now. What advice would you have as we kind of navigate what is likely to be a challenging, next 6 months?
From an investment standpoint, or just from a human being standpoint?
Both.
Well, most human beings would do well just to get off their phone for a bit. Like I put my phone in grayscale. I have rules around when I can use my phone. So when I'm in the family room or at the dinner table, phone goes away. Nothing good happens when you are staring at the news cycle 24/7. News is designed to make you feel worse. There's been multiple studies over the last 30 years that if it bleeds, it leads. Meaning if it's catastrophe, it's a train wreck, it leads on the front page of the news. And it's designed to make every world problem your problem. That's the quickest way to be miserable. And then the other thing human beings do now, and the tech companies are very good at this, but they see what you're clicking on, and then they feed you more of what you click on. So like you're not getting a different viewpoint. You're not getting the counter argument. You're getting confirmation bias, things that you believe reinforced. So I would just be mindful. If you don't know who the product is, then you're the product. Screen time is meant to be addictive. The algorithm is meant to keep you engaged. So just be mindful of that. A lot of folks are not mindful of that. And then from an investment standpoint, goes back to what I just said. Like investing is not full sending risk during good times, obsessing about performance, shunning risk management, and then a crisis comes and then you go in and make a bunch of changes. That's why people hire us, to get rid of that emotional cycle, which is a recipe to make massive mistakes and drive yourself nuts. So again, I sound like a broken record, but I've seen this movie before, and part of our investment process has a sentiment component, meaning what people are seeing, what people are saying, what people are doing, how investors are feeling. And I can tell you most people are super obsessed with performance because the last 3 years have been pretty good. They have no clue how much risk that they're taking. And it's true for advisors too. Like we ask prospective clients to go back to their advisor and show them how much risk they're taking. And I'd say 99% can't do it. So that's what really separates us, is we lead with risk management. Most of our clients are retired or about to retire, and they don't want to go back to work. So we very much understand, if we do get a correction, how portfolios should respond based on the last year and a half. And I always say that bear markets are really good feedback pieces. And we got one last April where the S&P was down 20% in a very short period of time. That's a great time to kick the tires on risk, make sure the portfolios are reacting the way that we intended. But if you can't track that, then you're setting yourself up for failure.
Yeah, and it's important to remember that historically, the market goes down 10% every year, on average. Meaning it won't be surprising if we do get a pullback to that type of level. We had one last year in April with the tariff tantrum. So volatility is a feature, not a bug, of the markets. The reason that we're able to capture upside and have the performance is because the market has downside and volatility as well. So we just have to be prepared for that and be prepared to adjust as needed if it materializes.
Yeah, and that's a really good point. So average intra-year drawdown for the S&P around 10 to 12% a year, which means it's normal to have a 10 to 12% pullback each year. I think this year the max drawdown is like 3 or 4. So if this makes you uncomfortable, you're probably taking too much risk. And maybe being an aggressive equity investor is not for you.
Perfect. What do you got on your list there?
What's your take on just how things are like. What's your number one hot take based on what's happening now?
Number one hot take based on what's happening right now.
Like aside from our investment process, just like what is your gut telling you about where we're at in the cycle?
Yeah, as you know, I'm kind of a glass half empty guy and you're a glass half full guy. So I'm always looking for what could cause the market to go down, what could cause returns to be poor. So obviously I've got quite a menu in front of me now, given everything going on. But the market, quite frankly, has held up and been pretty resilient. I still worry about inflation. Obviously, I worry about an escalation in the Middle East. Things get worse before they get better. Those are some things that concern me. One of the things on my list that I was going to ask you about is some of the private debt. We've seen some interesting headlines over the past month or so, 6 weeks, where some of the private debt has been started to act a little squirrely. So those are some of the things that, if you say keep me up at night, those are some of the things on my radar screen. How about for you?
Yeah, the private debt thing is a bit scary, and I don't want to speak too much on that. One, our clients don't own any private debt or private investments. That's intentional. We have shied away from that. It's been in vogue, like the private equity, private debt space. I'm not saying that doesn't have a place for some folks, but for our clients, 1 to 8 million, 1 to 10 million, we feel simple beats complex. We like liquidity. We like transparency. We like tax efficiency. We like to know what we own. So all of those things are important to us. And that just so happens to be the opposite in private markets. And private markets really operate in the shadows. So just real quick, what happened after the financial crisis? Banks tightened their purse strings, right? They made a lot of bad loans. So a lot of the risk management folks within the banking system said, hey, we aren't going to lend to lower quality companies, startup companies, which really inspired the comeuppance of this shadow loan, private equity backed banking system where you had non-traditional lenders lending to these riskier, smaller companies or startups. And a lot of investors flocked to that space and funded that space because instead of getting 3 to 4%, you could get 8, 10, even 12%. So there probably was a heyday where there wasn't too much money chasing solid loan deals. But as investor capital flooded into this space, you had too much money and not enough good deals to fund. And guess what happened? That pile of money ended up funding bad deals or marginal deals. And now things are starting to come home to roost as rates have gone up. The economy's kind of bumbled along. And, with the advent of AI, there's winners and losers. Like a lot of these private debt companies funded software stocks, which obviously have sold off quite a bit in public markets. So it really remains to be seen how this plays out. And then the last thing I'll say, what's really ironic is the traditional banks didn't want to fund this, but they ended up investing in a lot of these private debt deals through their public stocks. So a lot of the big banks, they didn't want exposure. They ended up chasing performance, chasing yields because their investors wanted it. So there's starting to be some cracks showing that could be a credit event. That could be a lot of loans going bad, which isn't good for anybody. So that's something that we're paying attention to. And the last thing I'll say, risk is what people aren't talking about. No one had an Iran, Israel, US war on the radar going into 2026. I read all the research notes last year. That really was not a thing. Private debt, people have been aware of it, but they weren't really talking about it. So true risk is what people are not talking about.
Yeah, and I think on the private debt side, it's been an asset class that has performed tremendously over the past, 5, 7, 8 years, double-digit returns, limited losses, liquidity not an issue. So it's been an asset class that has done extremely well, and consequently, investors chase that performance, chase that return. And so too early to tell if the things we're seeing now are just idiosyncratic things popping up or if it's the start of something more significant. But for us, it's just a reminder that the liquidity is great, but when it disappears quickly and you're not able to get your money back. So Not saying that's where it's headed, but it's certainly something to keep an eye on.
Yeah, the one thing that I really don't like about private markets, so private real estate, private debt, private equity, is when it goes bad, it really goes bad. I'm talking catastrophic wipeout. And for most of our clients, they are retired or about to retire and they don't want to go back to work. So something with such a wide range of outcomes that's not very transparent, that doesn't price every day, it's just not a sandbox that we want to play in. That said, for folks with plenty of public market exposure that are looking to diversify, it does have a place, but you have to be very diligent. You have to have a team. That's all they do. That's eat, sleep, and drink private deals and really know what you're buying. Because the worst thing that can happen is if, you make a bad investment based on chasing performance and it blows up and you lose everything.
Yeah, and it's worth mentioning that Waverly has private debt and private investments. And again, it's important to have an experienced hand on the wheel, experienced operator that's identifying those deals and making those investments if you are gonna tiptoe into that space.
Question for you. What's your thoughts on the Fed, the next Fed chair, what spot the Fed is in now that a war has broken out and oil prices have spiked? Certainly not an enviable chair to be in.
Yeah, it's a bit of a high wire act. Even before the war, it was, hey, is there still too much inflation in the economy for them to start cutting rates? Obviously, the president would like rates to be lower for a variety of reasons. They're bringing in the new Fed chair, Kevin Warsh. Warsh, how do you say that?
Mm-hmm.
And I got to believe that the mandate that he has been given from the president, doesn't mean he has to do it, but is to get the rates down. And so if you're concerned about inflation and now with a war raging, that's only going to feed inflation. It becomes a pretty tricky brew to decide whether to lower rates, hold rates where they're at, or maybe there's an argument at some point to have to raise rates. Well, the market certainly isn't anticipating rates being raised. And I think the market is still forecasting a couple of rate cuts this year. I think it's just difficult to predict whether that's going to come true.
Well, the rate prediction market, there's actually a futures market that does price all that in. And what it's saying is basically rate cuts are being pushed way out. And I think they're even all pushed out into next year, which, to your point, investors are basically saying the Fed can't cut just because of what's happening with oil. Inflation, that last mile is really tough to go from 3% to 2%. So that's been fleeting. And then there's all sorts of, like I saw a regional inflation index. There's a true inflation index that's showing 1% inflation. So you can argue about how the Fed calculates inflation, but certainly there's pockets of inflation. Higher oil prices certainly don't help. Although, I read something like back in 2010, energy prices explained more inflation than they do now, just because consumers are driving EVs. They're using different forms of transportation. Uber's become a bigger thing. So I think we're less dependent on energy, but it still very much matters. And I kind of chuckle, as much as we talk about AI and technology, you get oil prices spiking, which is very old school, industrial, traditional brick and mortar economy, and it throws things into a high wire act. So we're still very much in the analog world, despite all that we talk about with AI and technology.
Okay,
what else do you have? Because I don't really have much more.
Question for you. So, I have friends, family members that this time of year like to escape the Northwest and head to sunnier locales. What's your take on that? Are you all for that? Is that something you're going to have be part of your calendar if you can swing it? Or are you kind of hey, just like being in the Northwest, okay with the rain, and we'll just look forward to spring?
Well, I'm in a bit of a different life spot than you. I have 3 kids under 12. Oldest is 12. My youngest is 6. So they're fully immersed in sports. So even if I wanted to go somewhere, I probably couldn't. But that said, spring break, Thanksgiving break, we're heading down to St. George, Utah, doing the Mount Zion Park tour, which I'm really excited for. It's going to be 90 degrees. The kids are excited for that. A lot of swimming. But eventually, like once the kids are out of the house or more grown, I could see myself, because I do play golf. Being here in the winter months is not conducive for golf, so I could see myself being a snowbird, as they call it.
Yeah, definitely seen the benefit.
Yeah,
We snuck away for a long weekend recently and leaving 1.5 inches of rain every day and going somewhere where it was 80 degrees and sunny every day. You kind of look around and go, yeah, I could definitely use this type of a break. So I don't know if I'll end up being a snowbird, but getting away for a long weekend or two in a gray winter isn't a terrible thing to do.
yeah, and one thing I'll add is we've had clients buy a second home somewhere, and almost every single time they say, I don't want to keep up two homes, and they end up selling it a few years later. So I think a really good approach is maybe rent an Airbnb for 2 or 3 months somewhere, see how you like it, and that allows you to bounce around, not have to maintain another property as well.
That makes sense. You should point out our new sign.
I think we had this last time,
Did we?
but yeah, the Pure Portfolio sign is gone. It's actually in my office. I'm going to hang it up in my man cave once I get back in my house. But this is our new sign.
Any updates for people? I ask questions all the time. How's it going with Waverly? What's the first month or two? Anything surprise wise? Anything you would say?
I'd say we're still getting our feet wet as far as the capabilities that the firm has. Obviously, a much bigger firm. There's a lot of other resources that we knew about and some that we didn't know about. So kicking the tires on all of that. And then eventually we're going to learn more and roll that out to clients on a strategic basis. And then the first month was just migrating tech stacks, which I don't think is anyone's favorite thing. But we fired up our content again, which is great. Clients probably have noticed that we haven't missed a beat. We talk the same investment approach, same content on the weekends. Still trying to figure out the marketing equation just because it's a little bit different under a different umbrella. But I would say it's gone better than expected. Everything Waverly has told us before the deal commenced to after has rang true, which is really nice. And that just reaffirms our belief that they were the right partner for us. And we feel very good about the partnership, about our future course. We feel great that we're able to have a direct line to our clients, and nothing has really changed other than the name on the door.
Yep, I would echo all of that and put a plug in for the people. Continue to be amazed at the folks at Waverly. Doesn't matter what discipline they're involved in. They bring a desire to serve and an energy and an enthusiasm to help people, whether that's helping us help clients or whether it's helping clients directly. So we continue to be amazed and impressed with that and feel fortunate to have found them as a partner.
We also have a new associate, Sami, Gianella. I hope I said that correctly. She's a CPA. She's passed her CFP. She's just needs to check the years worked box,
Experience,
right?
Yep.
Experience box. But she's been sitting in client meetings. She's going to be a really good resource, not only on the planning side, but the tax side. It's nice to have the tax expertise in-house because a lot of folks, of course, are trying to navigate our tax code, tax forms this time of year. So she's been very helpful. So looking forward to getting her in front of more clients, maybe getting her on the podcast. I think she wrote a blog this past week, which clients will get in our Sunday Coffee Read series. So welcome, Sami. Glad to have you. And with that, that's almost 30 minutes. Happy half hour. Toby Weber, Nik Schuurmans. We'll see you after tax season in April.
Cheers.
Take care.